Marketing loans are used post-harvest, and they provide an opportunity for growers to use the crops for collateral on loans. The loan value is based on the marketing loan rate and is a portion of the crop's value. Risk management support is facilitated by the loans, as farmers with a marketing loan may choose to forfeit the crop if the market price falls below the loan rate. Now, according to the American Farm Bureau Federation, marketing loan rates have not been changed in a meaningful way in more than a decade. Now, the update that's included in the new 2018 Farm Bill, though, allows these rates to be increased and modernized. Loan rates increased for all crops other than upland cotton, peanuts, and minor oil seeds. Corn loan rates increasing from $1.95 per bushel to $2.20, while soybean loan rates increasing $1.20 a bushel from $5 a bushel to $6.20 per bushel. Well, we move from loan rates now to the weather. In the Weather Company's latest U.S. seasonal forecast for the January through March period, meteorologists are predicting warmer than normal temperatures across the northwest third of the U.S., with below normal temperatures across the eastern and most of the southern U.S. The most significant cold relative to normal expected across the southeastern U.S. after an unusually cold 2 months from mid-October to mid-December, now seeing an extended moderation period. Todd Crawford is the chief meteorologist at the Weather Company and says the December moderation is typical for the magnitude and flavor of El Nino that we currently have, but he says the analogs also suggest sharply colder risk with time as we move into January and February. He also says the high latitude blocking that we had in November strongly correlating with the reemergence of blocking later in the winter. Finally, the stratospheric polar vortex is expected to undergo a major warming in the new year, which also tilts the odds towards colder risk in the eastern United States. And given the evidence, he says they're maintaining their cold, stormy forecast for late winter. Well, plains feeders are on guard, if you will. According to the Ag Center in Amarillo, seasonally and historically, fed cattle prices reached their high in February through April. And last year, the fed prices hit their peak in February, but the month can vary with the year and with winter weather. Futures prices generally anticipate the seasonal high, and it's not unusual for February and April to carry the premiums to the cash markets this time of year. So while those premiums are not as large as normal, they do remain $3 over today's cash. So allowing those premiums to encourage and entice cattle owners into hedging their inventory is an often told story. But they say while cattle feeders can lock in the basis, they're unable to lock in the weather, so many wrecks occur when cattle targeted for the February through April finish period encounters severe winter weather. Cost of gain skyrockets and performance moves into suspension mode, with cattle sometimes losing weight rather than gaining weight. Now, the plains feeding belt is a far cry from the desert Southwest, where usually we'll see winter temperatures and moisture in rare form. But the object of picking up an extra $2 margin per hundredweight is based on the premise of gains not impacted by weather. Ag Center warns that weather interference can quickly turn an anticipated premium into a $50 to $100 head loss as cattle owners sell weather-stressed cattle. With another Ag News update, I'm Tony St. James.